All right, guys. Let us quickly revise interest rate risk management. The first thing that we have discussed in this chapter, guys, is that interest rate fluctuations would have a heavy impact on profitability of banks, financial institutions, guys, or capital intensive industries. All of which, guys, will depend on borrowings to a great extent, or they will have interest income as such, guys. So if you talk about banks and financial institutions, a major portion of their income as such, guys, is obviously better dependent on interest rates. So any change in interest rates as such, guys, can impact either the amount of their income or it can impact the amount of their expenditure. The interest rates better that prevail in an economy as such, guys, I told you, are prima facie based on first important factor is inflation rate. If the inflation is high, guys, obviously the central bank would want to target the inflation so that the purchasing power of individuals do not decline much. For that better, the interest rates also will be increased. If the inflation rate is less as such better, the interest rates will be decreased. That is the first part as such better, which is inflation. The second part beta is the demand and supply of money, which is the liquidity prevailing in the market. Higher the amount of liquidity in the market, guys, that is higher the supply of money, lesser will be the interest rate. Higher the demand of money, beta, lesser will be the liquidity, higher will be your interest rates. Then I also told you beta that government policies and government borrowings as such, guys, are the ones that are going to impact your interest rate. Government policies as such, guys, in the form of your open market operations, or guys तुम्हारा central bank का policy, fiscal policy of a government as such, guys, whether they're trying to consolidate the fiscal deficit like what we have seen in the current budget better, that the government is on track to reduce the fiscal deficit as such better. But for that better, they reduce the amount of, they did not reduce capital expenditure, guys, but then they kept the capital expenditure constant in comparison to the previous year budget as such, guys. And that is why even if there was a tax cut as such beta made in personal taxes, the amount of government borrowings have increased to offset that as such beta. कहीं ना कहीं से तो पैसा लाना ही पड़ेगा उनको. So if the government is borrowing more as such, guys, there will be a pressure on interest rates. Your interest rates are going to remain higher. Let's say we have predicted, matlab as of now the estimate beta is that the long-term interest rate might be settled in the range of 6.75 to 6.8%. Only because government is going to borrow more. So these factors beta are going to have an impact on your interest rates. After that beta we spoke about the concept of reference rates. I said reference rate, whenever there is a floating rate instrument as such, guys, there will always be a reference rate. You will determine the amount that is actually receivable or payable, guys, by using that as the base rate. So earlier as such, guys, and also beta all the derivative contracts as such, guys, that are based on floating interest rate will also be needing a reference rate. So earlier, guys, I told you that LIBOR was used as such, guys, for multiple currency transactions globally as such better. They had a panel of banks based on what, guys, the assessment of these panel of banks as such, guys, estimates as such better, LIBOR was decided. But because it was subject to manipulation as such, guys, it has been discontinued. Now every country as such, guys, has their own reference rate as such, guys. I told you India mein beta we majorly use MIBOR, which is Mumbai Interbank Offer Rate, the rate at which beta bank is willing to lend money. MIBID as such, guys, is the rate at which a bank would want to borrow money. Mumbai Interbank bid rate as such, guys, that is MIBOR. We have references to MIBOR only beta in all the official agreements. I also told you beta that RBI has introduced secured overnight rupee rate, guys, SORR. I said it has been just introduced. It will take a little time as such beta, wherein all of the contracts will be fixed to SORR. So SORR अपने syllabus में नहीं है, guys, just a term. So that is actually based beta on the rates at which transactions were executed in the overnight money market. ठीक है? Secured by collaterals, which can either be government securities or a tri-party repo. Tri-party repo matlab beta you're using underlying corporate bonds as such, guys, security. But that is still a repo transaction only, guys. So that is SORR. US में beta there is also an overnight index rate as such, guys. सबके अपने अपने reference rates रहेंगे, guys. After that reference rate beta benchmark rates, we moved on to the types of interest rate risk. The very first point, guys, under types of interest rate, do not forget beta that the theory question can be asked from this chapter. I already told you at the beginning of the chapter beta that there can be a question asked. Types of interest rate risk mein beta the first point is gap exposure. In fact beta traditional gap analysis is one of the methods to measure interest rate risk, guys. Gap exposure mein you should know what is the meaning of the word rate sensitive assets and rate sensitive liabilities. A rate sensitive asset, guys, is where the amount of income that you're going to derive from the asset beta will depend on the prevailing interest rates. Likewise, a rate sensitive liability beta is a instrument where the amount that you have to pay as such, guys, will depend on the prevailing interest rates. In case a bank has more rate sensitive assets and rate sensitive liabilities, we refer to it as positive gap. In case a bank beta has less interest rate sensitive assets but more rate sensitive liabilities beta, it will be termed as negative gap. By measuring this positive gap, negative gap, we can compute earnings at risk. That is what I showed you the report of HDFC Bank beta, and I showed you that they have mentioned in case interest rates increases by 2%, in case interest rates decreases by 2%, what will be the impact on their earnings. That is nothing but a traditional gap approach only, guys. After gap exposure beta, we did the concept of basis risk. I told you basis risk as such beta arises when your assets and liabilities are benchmarked either to two different reference rates or beta one reference rate but with different maturity periods. Both of them need not move up and down as such beta by the same proportion. That is where beta it may create an impact on your interest rate income or interest rate expenditure. Then beta we had embedded option risk. Whenever market interest rate fluctuates a lot as such, guys, imagine that if the interest rates are increasing drastically in the market, all your fixed deposit holders beta might approach the bank and opt for kya beta? Cancellation, prepayment of their existing fixed deposits, guys, so that they can deposit at a higher interest rate. Likewise, guys, what if there has been an increase in housing interest rate loans as such, guys? Won't your borrowers want to repay the loans? Whenever the interest rates have increased as such, guys, people would want to repay their loans earlier beta. वैसे ही बेटा what if you have invested in bonds, guys, which are callable bonds, and the other person as such beta has made a call to redeem these bonds? Can all of this have an impact on your interest rate income? So that is called as what? Embedded option risk. First wala gap exposure hai, second wala basis risk, third wala is embedded option risk. After this beta, the three risks that we have learned are the same risks that we have also covered, guys, in bond valuation. We have yield curve risk, we have reinvestment risk, we have price risk. Yield curve risk beta is not necessary as such, guys, that a change in short-term interest rates should have the same impact as such, guys, on interest rates of different maturities. Interest rates of different maturities beta can change by different proportions. I give you an example beta where short-term interest rates in 2020 were about 3.5%, 4%, but the long-term interest rates were still 6%. The gap between them was 2%. Gradually as such beta, when short-term interest rates were increased to 6.5%, long-term interest rates are still in the range of 7%. The gap has now come down to 0.5%. This changes the entire shape of the yield curve. Reinvestment risk beta is whenever you have cash flows as such beta realizable over the period, and if there's a change in interest rates, the reinvestment income that you're going to realize on reinvestment of these cash flows beta will differ. It will be based on the current interest rate risk. What did we learn in bond valuation? How can you offset your reinvestment risk and price risk? Immunization. Invest in a bond for a period equal to its duration. Or you invest in a zero coupon bond beta for a period equal to its maturity. That also is the duration of a zero coupon bond. So price risk, reinvestment risk, and yield curve risk. These are the normal interest rate risk beta. Uske alawa gap exposure, basis risk, and embedded option risk. These are all your types of interest rate risk that are covered in this chapter. After that beta, we moved on to how do we measure interest rate risk. As far as measurement of interest rate risk is concerned, guys, I told you that you will have, guys, your traditional gap analysis. What is traditional gap analysis? Measuring beta your rate sensitive assets and rate sensitive liabilities. Abhi jo padhaya, that is one way of measuring how much earnings at risk, guys. Are you not measuring how much is the risk exposure that we have? So one is traditional gap analysis. The next one beta is value at risk. VAR as such beta is again the concept that you have learned under risk management. It is computing, guys, under a 99% case scenario wherein you will take a Z score of 2.33. You will create a scenario, guys. What if things fluctuate in a negative way as such beta? What is the maximum amount of risk that you are facing? Then beta duration, guys. Duration kya measure karta hai beta? The time period over which we will be protected against interest rate changes. And simulation. What is the advantage of simulation? You do not change all the factors at once. Randomly as such beta we pick up factors wherein one factor can be favorable, one factor can be adverse. So ये कोई standalone theory question नहीं है बेटा. This mentioned in the form of a statement that you can measure your interest rate risk by traditional gap analysis, value at risk, duration, and simulation. I told you beta, most important from the viewpoint of measurement of risk as such, guys, is understanding what is trading book and what is banking book. Trading book as such, guys, comprises of those assets and liabilities, guys, which a bank intends to settle in the near future, guys. Objective is to gain on account of fluctuations in value. Banking book as such, guys, comprises of assets as beta where the bank intends to hold them till the maturity. That comprises of your basic loans as such beta that we give as a part of our business. So for trading book as such, guys, it is value risk, that is price risk. But for banking book as such, guys, it is earnings risk. Whenever interest rate changes, guys, banking book mein we are concerned about by how much will our earnings increase or decrease by. Whenever interest rate changes for trading book, we are concerned by how much will the value change. Once you know how much is your value risk, once you know how much is your earnings risk, it will be useful as such beta to implement techniques as such, guys, for avoiding these risk. इसके बाद में बेटा we have moved on to ये techniques हो गए. हाँ, hedging interest rate risk, guys. Under hedging interest rate risk, I told you better that we have traditional methods and we have modern methods. Under traditional methods as such, guys, there is asset liability management, forward rate agreement. Under modern methods beta we have interest rate futures, interest rate options, we have interest rate swaps and swaptions. These are the things that are covered in our syllabus. Except for asset liability management and swaptions, on everything else we have practical questions. First one beta is asset liability management. Even for this we opened the report of HDFC beta just to show you. यहाँ पे क्या पढ़े थे बेटा? There is main liquidity risk as such, guys, and interest rate risk in banking book. What is liquidity risk that a bank can face? There was an article on this also beta in one of the journals of अपने CA Institute based on this same concept, asset liability management का importance बोल के they've explained about all of this only. You know, no, मतलब they keep writing articles as such, guys, on multiple topics every month as such beta. There are 3-4 articles that keep coming up on good topics. But anyways beta, वो सब के लिए अभी बाद में ये अभी क्या बेटा liquidity risk क्या है, guys? What if all the deposit holders as such, guys, come and want to withdraw the money at once, guys? So then beta bank may not have sufficient amount of funds available as such, guys, to repay all of them at once. Also, guys, what if there is a mismatch as such, guys, in the timing of cash flows that are receivable on your assets and the timing of cash flows, guys, on your payables? All right, guys. Interest rate risk beta in banking book अभी जो पढ़ा है इसके पहले, that a change in interest rate as such, guys, can affect. So this is where, guys, what a banking company can do, what a bank should do beta is try to match their average age of receivables with average age of payables. They will also see, guys, how much amount of liquid assets are available with them as such, guys, to fund their outflows for over the next 15 days, over the next 30 days. It is mandatory as per RBI beta that they present whether they have sufficient liquidity to pay off everything over the next 30 days or over the next 60 days, guys. वो पूरा calculation करके they have to keep submitting those reports to RBI. This is to ensure beta that there is sufficient liquidity available with banks and they do not end up parking all of their funds as such, guys, in longer assets. So that's the first one beta. What is that? ALM. Next comes what, guys? Forward rate agreement. I told you a forward rate agreement is an over the counter derivative as such, guys. OTC. It is a direct contract between two people as such, guys, to borrow or lend money on a later date for a specified period of time. If I use the word 6x9 FRA beta, it means that I would want to borrow money after 6 months for a period of 3 months. A person who intends to borrow, guys, will enter into a contract to buy an FRA. A person who intends to lend money beta will enter into a contract to sell FRA. FRA mein the underlying is directly interest rate. It is not a bond. That is why, guys, whoever wants to borrow will need to buy. Whoever needs to lend will need to sell. You will have to relate this with interest rate futures where the underlying is a bond and not interest rate. So here, guys, under a forward rate agreement, guys, you are simply entering into a contract to borrow or lend money on a later date. The most important point that you have to remember beta is that FRA, guys, is settled in cash in present value terms. Meaning, if I enter into a 6x9 FRA, I will exactly know what is the prevailing rate, guys, after 6 months. And I know that borrowing is for 3 months. You are not borrowing money under the forward agreement. It is being cash settled. Will it be settled at the end of 9th month period or at the end of 6th month period? 6th month period. That means it is settled upfront. Because it is settled upfront, guys, it has to be settled in cash. The formula that you can see in front of the screen, guys. Why do we call it as notional principal? The underlying principal amount is never exchanged. That is why it is notional principal. If you are actually borrowing or lending money beta under a forward agreement, then you need not have to use the word notional principal. So you write notional principal multiplied by whatever is the prevailing rate, that is reference rate, minus agreed rate, multiplied by number of days by 360, whole divided by, always to be discounted at reference rate. Say for example, I have entered into an agreement to borrow at 5%. And the ongoing rate is 5.5%. Did I not make a gain of 0.5%? I already entered into an agreement to borrow at a rate of 5%, but the ongoing rate is 5.5%. If I wouldn't have entered into an agreement, I would have had to directly borrow at a rate of 5.5. So under FRA, we will gain 0.5%, but computed proportionately only for that 3 months period, divided by discounted upfront. Are we clear about this? This is how beta you settle an FRA. Whenever they ask us to compute profit or loss, please remember that it is settlement amount and has to be computed in present value terms. If they just ask us to compute what will be the effective interest, then beta you can directly present what will be the overall interest outflow. Effective interest kitna rahega guys? In case I enter into an FRA and they just ask me to compute effective interest, on FRA I will gain 0.5% and then I will borrow in the market at 5.5%. My effective interest outflow will still be 5%. So that's the first one guys, forward rate agreement. Any doubt in this? Next beta, talking about interest rate swaps. Interest rate swap mein beta I told you that a swap agreement is nothing but an exchange agreement. Normally when you say swap agreement guys, it is a agreement to exchange fixed rate of interest with a floating rate of interest. A person who has a floating rate borrowing guys might want to hedge in order to protect against interest rate fluctuations. Because your primary borrowing is floating rate, what will you do guys under swap? Receive a floating and pay fixed. Always remember that. Are we clear guys? If nothing is given beta, buyer of the swap kaun rahega? Fixed payer. Excellent guys. They might ask you to identify that in the examination. Number 23 question. Buyer of the swap beta is the one who is paying fixed. Seller of the swap is the one who is paying floating. Two parties, one pays fixed, one pays floating. So under an interest rate swap as such beta, we are entering into an agreement as such guys to hedge our interest rate risk. The types of even here guys, we call it as notional principal only because we are not exchanging the underlying principal, but we will settle the difference in cash. The only difference beta is that it is not settled upfront, it is settled on the settlement date. That is why you do not have to discount it. You will take the difference, multiply by the number of days. Always remember, unless otherwise given, it will always be computed in days. So there are four types of swaps beta that we did here. If you see guys, all of this first. Plain vanilla swap. Plain vanilla swap kya hai beta? Wherever we use the word plain vanilla, I told you understand the swap agreement in its simplest form. So a plain vanilla swap beta will be to exchange fixed rate of interest with a floating rate of interest. Alright. Now, net settlement of swap I already told you as such beta will be on the settlement date. It will not be upfront. So they will ask us two things. How much should be your fixed rate payment? How much should be your floating rate payment? Then the net difference will be settled in cash. Fixed rate payment as such guys will always be computed in fixed number of days. Matlab if it is for 6 months, you write into 6 by 12 or into 180 by 360. Floating rate payment will be based on number of days that are comprised in that agreement period guys, actual period. So notional principal multiplied by all-in cost of funds into 180 by 360 beta will give us our semi-annual fixed payment. Floating rate payment as such guys will be your notional principal into whatever is the reference rate multiplied by अपने examples में बेटा पूरे questions में it was 181 number of days, but then they will mention that in the question guys. If they do not mention anything, well and good, take into 180 by 360, 180 by 360 for both of them. Are we clear guys? In दोनों का difference beta will be settled in cash. Do you remember these questions? Next beta is basis swap. Basis swap में beta I told you that the swap agreement is to exchange interest rates as such guys, floating rates as such guys, of either two different reference rates or one reference rate but with two different maturity periods. Asset swap beta, we did a question wherein we exchanged 1.15% fixed with the return of Sensex. The other day we did 1.15% fixed was being exchanged with return on Sensex. So asset swap mein beta we exchange a fixed rate of interest with the return of another asset class. That other asset class in our example was an index. Next beta is amortizing swap. I told you amortizing swap is exactly the same as plain vanilla swap. The only difference beta is that the amount of principal guys on which interest rate is exchanged will be reducing. Are we clear about this? The principal portion will keep reducing as such guys. Uske baad mein beta, the most important one that we've discussed is corporate swap. What is corporate swap? Imagine that I am A limited as such guys and here Neha is B limited. I want to borrow at floating rate. Neha wants to borrow at fixed rate. What do we check beta is there a possibility wherein I do not borrow at floating rate and she does not borrow at fixed rate? We do it the other way around and we try to save on the amount of interest outflow beta that we are paying to the banker. जैसे तुम्हारे सामने बेटा जो screen पे है, A limited beta requirement is fixed and he needs to borrow at 10%. Floating rate beta for B limited, which they can borrow at what rate? Repo plus 2.5%. without smiling, if they go as per their requirement, guys, the total outflow, guys, will be repo rate plus 12.5%. But if they do it the other way around as such, guys, the total outflow will be repo plus 12%. So if they do it the other way around, will they be able to save 0.5%? How are they sharing this beta will be given in the question. If they do not give anything, they are sharing it equally. 0.25% gain to A limited, 0.25% gain to B limited without texting. Yes or no, guys? In order to compute effective cost beta, all you have to write is what would have been your cost without swap. Without swap, your cost would have been 10%, and for the other party, it will be repo plus 2.5. What is the gain on account of swap? 0.25%, 0.25%. So from 10 you remove 0.25, from repo plus 2.5 you remove 0.25. This will become effective cost beta under swap. In case they ask us to show detailed calculation, guys, I told you always take one party as the base. Okay. Remember, they are not actually borrowing at 10 and repo plus 2.5. They are actually borrowing at repo plus 3 and 9%. So A limited will pay repo plus 3 to the banker. If you take A limited as the base, A limited will receive entire repo plus 3%, but will pay only its effective cost to the other party, which is 9.75%. Always consider one party as the base and then arrive at the amount of effective outflow. Are we clear, kids? This was about the swap agreement, but do not forget, beta, in the questions that we did, there were intermediary parties as such, guys, who wanted commission. So when you exchange, guys, what you will pay to the other party, beta, is your effective cost without considering commission, and let them pay commission separately. Is that clear, kids? After this, beta, we moved on to the concept of interest rate options. 1 second, guys. Do you also remember that overnight index swap, guys, that we did? 7 days wala. 7 days wala overnight index swap with the fixed index swap. यहाँ पे problem क्या था? That settlement was not being done at the end of each day. It was being done at the end of 7 days period. Because settlement was done at the end of 7 days period, guys, I said under floating leg you need to compound, except for Saturday and Sunday. Saturday and Sunday के लिए we directly wrote into 2 by 365. And fixed interest rate के लिए बेटा we directly wrote into 7 divided by 365. So guys, that is how beta we computed. Abhi beta, then we guys moved on to interest rate options, guys. Under interest rate option, guys, I spoke about the concept of cap, floor and collar. What is an interest rate? These are all over the counter derivatives. Sabko office jana hai. Over the counter derivatives, guys. When you say over the counter derivatives, what is an interest rate cap? You enter into an interest rate option as such, guys, wherein it puts an upper limit as such, guys, on the amount of interest outflow. What is an interest rate floor, guys? It puts a lower limit as such, guys, on the amount of interest outflow. Usually, guys, in order to hedge, you will only enter into an interest rate cap. You will want to put an upper limit. You will not want to put a lower limit. In spite of that, why do entities enter into interest rate floor? In order to save the amount of premium. We pay premium on interest rate cap as such, guys, but we are the buyer of interest rate cap. Interest rate floor, beta, we will be the writer. Because we are the writer of interest rate floor, guys, we will be receiving premium. That is going to reduce your overall premium paid upfront, guys. If you are entering into both cap and floor, we refer to it as collar, interest rate collar, guys. So I gave an example as such, beta, wherein we were comparing Mibor with 6%, Mibor with 4%. I told you, show the amount of interest outflow, guys, under primary loan separately. Show whatever is the amount of inflow under cap or outflow under floor separately. Then arrive at the amount of effective cost, overall cost. That was under interest rate option. Yes or no? याद आ गया बेटा ये? Compare your reference rate, guys, with the strike rate. After that, beta, abhi जो आज पढ़ाया beta, that was about interest rate futures. What did I tell you, beta, under interest rate futures? Under interest rate futures, guys, I told you that in real life as such, guys, as of now, NSE interest rate futures, guys, are on government securities with a maturity of 6 years, 10 years and 13 years. All of them as such, guys, are based on an actual bond underlying. It is no longer a notional bond. You have an actual bond. But guys, interest rate futures mein, because the underlying is a bond and not interest rate as such, guys, it will be the other way around. Interest rates and price of a bond have an inverse relationship. So if you are the borrower, guys, you do not buy an interest rate future, you sell an interest rate future. Are we clear about this? Keep that in mind. A borrower will not buy, he will sell an interest rate future. So all the interest rate futures that are listed on NSE as such, guys, are cash settled on a daily basis, and even on expiry beta they are cash settled. However, when the interest rate futures were first introduced as such, guys, I told you that it was physically settled as such, guys, by delivery of the bond. Now, the interest rate future contract was based on a notional bond, guys, but the actual bond that can be delivered need not be the same as notional bond. So if it's a 6-year notional bond, I told you better that SEBI permitted bonds with a maturity of 4 to 8 years to be delivered. Okay? Because they do not perfectly match with the notional bond as such, guys, what do we do better here? There will be a conversion factor. So in case your future settlement price is 1000 and the conversion factor is 1.1, you will actually receive 1100 rupees when you deliver the bond. Why do we have conversion factor? To make the prices comparable. You are not actually delivering that notional bond, you are delivering a bond with a different maturity period. Are we clear about this, guys? Yes or no, beta? So you multiply future settlement price with conversion factor. Now here, beta, they will ask us to compute what is cheapest to deliver, CTD. Cheapest to deliver matlab kya, guys? If I am the one who has entered into a contract to sell interest rate futures, I will be the one who will be required to deliver bond on the expiry date. So I will have to buy that bond from the market and deliver that bond. So whenever I'm buying from the market, I will have to buy the bond beta at the quoted price. When I'm delivering as such, guys, the delivery price beta will be settlement price multiplied by conversion factor. So I will see, guys, as to what is the difference between this delivery price and quoted price. That will become my profit. Imagine I'm buying a bond at 1030 rupees but delivering that at 1040 rupees. Am I not gaining 10 rupees? Aise I will have to compute for all the bonds. Whichever bond is maximizing my gain or minimizing my loss, that will become cheapest to deliver. Are we clear? Likewise, interest rate options we have beta exchange traded. We do not have that in our syllabus. Liquidity nahi rehti practical market mein. And the last one beta was swaption. What's a swaption? You are entering into an option contract as such, guys, which gives you a right to enter into a swap agreement within a specified period. The swap agreement terms and everything beta will be decided beforehand only. That is called as a swaption. ठीक है beta? So that's the end of the revision, guys, of interest rate risk management. Online students, we are taking a break as such beta of 2 minutes and then we'll start after that.